I'm Natalie Trout, a wealth advisor and chief operating officer at Elevation Wealth Partners. Today, I'm in conversation with Max Barnett of Janus Henderson. He has over 11 years of experience in the finance industry and has been with Janus since 2023. Welcome, Max.
Thanks, Natalie. Happy to be here.
So let's start with the big picture. How is Janus Henderson viewing the markets right now?
Yeah, I mean, right now we're pretty optimistic, especially long term, even intermediate term. We still think there's a lot of room for growth. There's obviously been a lot of growth over the last few years, but we certainly don't think that excludes the possibility for future growth going forward. In fact, we do think it's likely. Now, that doesn't mean we're just going to have a smooth ride over the next few months. There could certainly be volatility, but for anyone who's focused more on long-term goals, we think the current environment has them very well positioned.
So investors shouldn't necessarily expect a straight line higher.
Yeah, exactly. I mean, I would basically never tell investors to expect just a straight line higher when it comes to investing, right? There's obviously risk and volatility associated with it. But the next 6 months in particular could potentially be a little bit choppy. Markets, they rarely move in a straight line. But even if we do see some volatility over the short term, that certainly doesn't change our positive outlook over the next, 2 to 5 years or so.
Absolutely. We wish that the market would just go up every day, but
That'd be nice.
unfortunately not. Yeah, and then last week we did have an inflation report that came out. What did you take away from that?
Yeah, the big takeaway was that it actually came in a little bit lighter than expected. And that's certainly encouraging. People thought that inflation was going to be a little bit hotter, especially due to the whole Iran situation and the Strait of Hormuz creating a little bit upward pressure on prices. But it's a modest positive, and we don't think it dramatically changes the overall outlook that we have anyway.
And what does that mean for interest rates as a whole?
Yeah, so overall, it's positive for people who would like to see rates lower. However, at the end of the day, our view is that rate hikes remain at least as likely as rate cuts for the rest of the year, if not maybe a little bit more likely. It's very possible that the Federal Reserve just simply holds rates where they are right now. But the market's kind of gotten back into that bad news is good news mindset where weaker economic data can actually cause stocks to rally because that makes investors assume that there's an increase of rate cuts or odds at least of rate cuts being in the future. So we're kind of in that weird situation right now. But that's essentially what we're looking at.
Yes, and investor sentiment, that is one of the big drivers of the markets. Besides the economic data, what are you watching that could affect inflation or interest rates?
The big thing would be geopolitical risk. We would say that geopolitical risk is probably the biggest risk currently. Now, that's a positive thing, big picture wise. We'd much rather see a stable economy and uncertain geopolitics as opposed to an unstable economy, but more stable geopolitics, because politics kind of come and go, whereas the economy is more of a long-term driver. But we've seen, ceasefires in the Middle East begin to deteriorate, and that's caused some additional disruption around the Strait of Hormuz. And if that does continue, we could see energy prices rise quickly. Higher oil prices would add inflationary pressure and could make it harder for the Fed to lower rates, or even increase the likelihood of another rate hike, which, again, the market would probably not love. But again, this is very, very short-term implications and certainly doesn't do anything to change our long-term or even intermediate-term outlook of overall positivity and bullishness.
Yes, absolutely. And we always want to be looking at the long term, not what's happening day to day in the markets. And, you lost this much today in dollars and you gained this much the next day. It's all about what's going on over a longer period of time. Uh, so let's switch gears and talk about bonds. It seems like fixed income is finally getting some attention again.
Yeah, and rightfully so, in our opinion. Bond yields right now are at levels that we haven't seen in about 20 years since before the great financial crisis of 2007, 2008. And this is largely the result of that aggressive rate hiking process from the Fed that we saw immediately after COVID in 2022.
And why is that important for investors?
Yeah, I mean, it's very, very important for the very simple reason that historically, the return that investors have gotten from fixed income over the long term have been very highly associated with what the starting yield is. So, whatever the yield or return that a bond is offering, that's a very good forward indicator or predictor of its future total returns. So, given the fact that rates are higher right now than they have been in about 20 years, that means that it's a much more attractive environment to be a bond investor than it has been in the last 20 years. And so if you're an investor with a diversified portfolio, say that 60-40, 60% stock, 40% bond, traditional portfolio, bonds can once again give you meaningful access to income while also providing you protection against equity market fluctuation, as opposed to 10 years ago when they were yielding about a third is what they're yielding right now, and really were just a drag on portfolios other than the protection that they could provide. But if you can get both income and also protection from bonds, that's when the bond market is really attractive, and that's exactly what we're seeing right now.
Yes, and if you're an investor with Elevation and you've been in for a meeting recently, we have pointed out to you, hey, this is why you have bonds in your portfolio and look what they're doing for you. And one thing I hear all the time is that people feel as though the economy is just doing absolutely terribly. But when you look at the data, that doesn't always seem to be the case. Why do you think there's such a disconnect?
Yeah, it's pretty interesting, especially when you actually peel back the layers of all that data that you mentioned. So almost every economic indicator that we look at, if you're just talking about something that's an objective number, is very, very strong right now. You've seen solid GDP growth. Unemployment remains very, very low. We're seeing average and median wages near record highs. Wage growth has been healthy. Consumer spending is strong. Household net worth and savings, those are elevated as well. So all of these numbers are actually very, very strong in spite of the fact that you frequently hear that the economy isn't doing well, which is pretty interesting.
When we chatted last week, you had mentioned a study about the middle class that I had found quite fascinating. Can you give us a little overview of that?
Yeah, absolutely. So this was a study that basically tried to attack, or not attack, but address the idea that we hear a lot that the middle class is essentially being eroded away, right? And there's a few different ways that you can measure the middle class, and a frequent one that I hear is basically, from, let's say, if you're in the 35th to 65th percentile for income, then you're middle class. And the problem with taking that approach is middle class probably isn't about what you make in relation to other people. It's about what type of lifestyle can you provide, right? So this study that Natalie mentioned, it used the example of if everybody's income was just doubled overnight, if that's the logic that you're using to define the middle class, then the middle class has not changed at all, even though everyone just got twice as rich, right? And that obviously makes no sense. So what this study did instead was that they defined middle class, upper class, lower class by how many times above the poverty line your income is, because that's a good illustration of how much you can afford, right? And so it actually broke it into four areas. It had lower class, middle class, upper middle class slash lower upper class, and then straight upper class. And each one got a multiplier above the poverty line. And it looked at 1985 versus today. And the really interesting thing was that a lot of people hear, oh, the middle class is being eroded, it's smaller than it used to be. And the findings were exactly that the middle class is smaller. But the findings were also that the lower class was smaller as well. In fact, what grew was the upper middle class and the upper class, meaning that the decrease, the quote unquote erosion of the middle class is not because people are getting poorer. It's the opposite. You've had so many people move up into upper middle or upper class that's why the middle class has gotten a lot smaller. So it's actually a positive thing when you're really looking at these numbers, which is interesting, especially given, what I generally hear in the news or from conversations from average everyday people.
So why do so many people still feel financially behind, in your opinion?
Yeah, I mean, I think it's a comparative thing that's mainly due to social media. Social media is so ingrained in our lives these days. I think it's really easy to keep in mind to forget about the fact that 10, 15 years ago, it wasn't as much. Like we had social media, but you would check Facebook like once a day, if that, right? Now it's in your face 24/7. So what are we always doing? We're comparing ourselves to people who are displaying extraordinary wealth and lifestyles that aren't representative of the average person, whether that's actually their lifestyle or not, right? So it's either people that actually are like the super rich that we're seeing thrown in our face a lot, or people that are pretending to be. And it makes us feel like we are a lot worse off than we actually are. The second thing, as well, is that social media platforms reward engagement. And unfortunately, negative content generates more clicks, comments, and shares than positive content does, right? And this just creates an echo chamber that reinforces pessimism, even when the numbers that we are looking at economically are telling a very different and much more positive story.
And when you start engaging with certain things online, the algorithm is going to keep feeding you more of the same thing. So it becomes more and more biased over time, right? So that's why we need to be looking at what is the data, what are the numbers, what is actually happening, not what am I hearing on Facebook or Instagram. And we also have, like, as you're saying, people who might be presenting themselves as having a lot of money. They're going on, 5, 6 trips every year. They're buying clothes to keep up with all the trends. What you might not be seeing is the credit card bill that may be behind that.
Yeah, I would say an easy way that I would think about it is that if you look at my Discover page on my Instagram, there's really only two things that you will really see, and that's going to be videos of French bulldogs and cooking. And it's not because the French bulldogs are the only dogs out there, right? It's because I have a French bulldog, and I my wife sends me French bulldog videos all the time because she's obsessed with French bulldogs, and so the algorithm, because I click on those videos a lot, are going to show me a lot of French bulldog videos, right? So if you're clicking on a lot more of these videos that are talking about why the economy is doom and gloom, that's going to be what you see. And that doesn't make it any more of the reality than that the only dogs that are in existence are French bulldogs. So again, just be cognizant of what is being curated to your feed.
That is an excellent example of what we're talking about. French Bulldog is not the only dog. Uh, so switching gears, artificial intelligence has obviously been one of the biggest investment stories over the past couple of years. Some investors worry this feels like the dot-com bubble. How do you see it?
Very much not in that light. We don't think it's an appropriate comparison at all. Obviously, it's an easy comparison to make because there's been a lot of growth. The stock market has done very well, and it's been around a new piece of technology. But if you're actually looking at the fundamentals of these companies, sure, there are isolated pockets where there are certain companies that appear to be, have their valuations more elevated than we think are deserved. But broadly speaking, today's market appreciation is really supported by the underlying fundamentals. We're actually starting to see, the hyperscalers, which are these companies that have spent so much on the AI build out, start to generate earnings from those AI business verticals, and those are also creating real productivity gains in other companies as well.
How significant do you think AI could ultimately become?
I mean, it absolutely has the potential to be the single biggest wealth creator in the history of capitalism, really. Will it get there? We'll see. We're pretty optimistic about it, though, and we really think that this is going to accelerate economic growth over the next several years, if not the next several decades. But bottom line is this has the potential to be, really the biggest technological advancement since the Industrial Revolution.
All right. Are there areas of the market that could still face challenges?
Yeah, certainly. I mean, especially companies that rely heavily on debt financing, especially if the fundamentals of that company have not, do not support a strong business yet. If interest rates continue to remain elevated, those companies could struggle a little bit because higher borrowing costs can create a tougher environment for those businesses.
Okay, so looking ahead, as investors think about the rest of the year, what should they keep in mind?
Yeah, cautious optimism would probably be the best phrase for it. You can expect a little bit of volatility over the next few months, and that might make things a little bit choppy for you. But we're not talking about volatility like, COVID or the financial crisis or anything like that. We're not expecting some 15%, 20% or more market sell-off. We could see markets move sideways for a time. We could see some bumps here and there, but overall, nothing to be overly concerned with.
And over the next few years?
Yeah, that's where we're very optimistic. When we look at, 2 to 5 years, when you consider just the combination of solid economic fundamentals, continued corporate earnings growth, attractive yields in bonds, and then these technological advances in areas like AI, this creates a really favorable environment, in our opinion. Honestly, one of the most favorable environments that we've seen in a while for long-term investors.
Max, thanks so much for joining us and sharing your perspective. It's always helpful to step back from the headlines and focus on what's actually driving the markets. And thank you all for watching. If you have questions about how today's market environment affects your financial plan, we'd be happy to have a conversation with you. Just give us a call. Max, thanks so much for joining us.
Thanks for having me.